Hey guys, welcome back. In this video I wanted to show you guys about the strategy known as the wheel strategy, or also known as the triple income strategy. So in this strategy, basically you make money three different ways by trading options. If you don't know what trading options is, don't worry, this is where I'm gonna go over it, explaining exactly what that means. So let's jump into AMD here. AMD trading options. So first thing you would want to go to is sell put. And so the way this works is like you're selling insurance basically. Someone has 100 shares of AMD and you're selling insurance saying, hey, if this thing drops to $50, right, I'll buy the shares off of you. I'll buy one contract if that's what you put. One contract is 100 shares. So if you were to buy a contract here, you would need $5,000 because it's 50. But for one share, and since you're buying 100, that's 50 times 100. And as you can see, I don't have the $5,000. I only have like what, $20 right now. So not a lot of money. But the way you make money is you get paid 51 cents per share, which you get paid, as you can see, $51 for going into this contract. Now there's two options that could happen. One, the price, as you can see, you have an expiration date. The price can go under 50 or it can stay above 50 by the expiration date, right? If this goes under 50, you will be forced to pretty much activate the insurance, right? You'll be the one having to pay for the totaled car, right? So you will have to buy the 100 shares at $50. So the price can be down all the way down at 46 or 48, it doesn't matter. If it drops under 50, you will buy them at 50. And so you will keep your $51, but you will buy the shares at 50. And then you'll have 100 shares of AMD with an average price of $50, right? The second option is, let's say it doesn't reach. So right now it's at 52, right? It's at 52, 54. If this thing drops to 51, but that's by expiration date, it never drops under 50, then you keep your $51 and the contract pretty much expires, right? Because it expires on July 10th. That's what that means. And so you can make money by the first place off this premium, right? So the probability of 52, it's at 52, 54. If it drops to 52, that's a pretty likelihood, that will happen. So that's why right here they give you $1.12 per share. And so since 100 shares, you're making $112 off the premium. But let's say you don't want to risk it, right? Let's say you really don't want to buy the shares, you just want to make money off the premium. Then you can go all the way down here, right? I don't really see the price of AMD dropping all the way down to $45. So the chance of profit is really high, 95% chance. But you only make like $7, right? 7 times 100, you only make $7. At 0.07, 7 cents times 100, that's $7. So you wouldn't make a lot of money if this were to happen. If we look at AMD in general for the past, for example, month, it hasn't dropped under 49, right? And so if we were to trade options, sell a put at 49, you can still make $35. And it probably won't go under 49. So you can make money off the premium. That's the first step. And then let's say you make money off this premium right here, right? And let's say the price does drop. And I'll show you guys a real example with AMD, because last week I put a call at let me show more. I put a call at 51. No, I sold a put, sorry. I sold a put at 51 and at 53 on June 26. And if you go to June 26, so the past week, we can see that on June 26, it was at around $51, and I put it at 51 and at 53. And so it dropped all the way down to 48. So it definitely executed the contract, and I bought those 100 shares, one at 51 and one at 53. As you can see, my average price is 52, and I have 200 shares of them. I had bought one already before, that's why it's 201. But I have 200 shares now. So now the second way to make profit is by just holding on to the stock, right? You want to do this with a stock. You don't really want to do it with a risky stock. You want to do it with a stock that's, you believe in. And if you look at AMD for the past 5 years, it's definitely growing, and it's definitely considered safe. Based on, that's just my opinion. I'm not telling you go buy AMD. I'm not a professional financial investor or anything like that. But so AMD, it's most likely not going to go bankrupt from one day to the next, right? Or 1 week to the next week. So I just held on to it for basically a week, and now it's back at 52. So my average price is 52.01 at 52.54, so I already made $100. So that's another way that I made profit, right? I made profit off the premium, right? So at 51 and at 52, I had made a profit off the premium. The 53, I made $138 off the premium, and for the 51, I had made $17 off the premium. This was something that I canceled. And so now that I have those 200 shares, now we're going to the third part of making this is the third part of the strategy to make profit. And so now that I already, I put insurance, I sold the put, and in my case, it did execute. If it wouldn't have dropped under 50, or for my case, under 51, 53, because I had two different contracts. For example, we focus on 51. If it wouldn't have dropped under 51, I would have just kept the premium and, the $76, as you can see right here, and I would have just moved on. But it did drop all the way down to 48, and so that means since it was lower than 53 and it was lower than 51, I ended up buying those 200 shares. So now the third part is just selling the call. So instead of the put, we go to call. And so now that the price is at 52, if I were to sell it at 53, right? So I had one contract at 53. If I were to sell at 53, I'd break even, right? I bought it at 53, I sold it at 53. All 100 shares. Didn't make money off there, except I made money off the premium when I bought the shares, and I can make money when I sell the shares. So right here, it's $1.22 per share. So that means if I were to add it, it's 100, right? 100 shares. So I'd make $122 of the premium. But let's say I want to make some profit, and I believe that I can go up to 54, right? Then I can go put it at 54. And so I would make the premium of $82. And I would, since I bought it at 53, I would be selling it at 54. So that's $100 difference because it's 1 times 100. And so I'd be making $182 plus the premium that I had made when I bought the shares. So pretty much to summarize, the way you can make money 3 different ways is by selling the put, right? So you're selling insurance. And if this thing were to drop to 49, you would have to buy under 49, you would have to buy them. If it didn't hit 49 by the expiration date, you wouldn't have to buy them. But regardless, you keep the premium. You keep the $35, the $51, the $76. The higher you go, the higher the price. And then if they were not to sell, right? If you put it at 49 or at 50 and it didn't drop to that, then you would just do it next week and the next week and the next week. And you could keep making money, $50 a week, right? And then let's say 1 week, for example, for mine, it did execute. The contract did execute. It did drop below the strike price. So then you could just hold on to it for a while until it goes back up. So since I had bought one contract at 51, now if I sell it at 53, I'm making $200. $2 difference times 100, that's $200 in profit of capitalization. And then I would also make money off the premium. So it would be $200 plus $122. That's $300. That's 300 and left over. And then whatever I had made when I bought the AMD shares. So this is it, guys.